Hello and welcome to the Tax Roundup for November 2014. Yes, it's November already. And Parliament is we're still debating where the money is going to come from for the budget. And it seems it's not going to come from an increase to the GST. Prime Minister Abbott's suggestion that we have a mature debate on an increase to the GST has been knocked back by Palmer United and the States. But despite that, there's still plenty to keep accountants and tax advisors on their toes this month. Michael Carruthers takes a look at the proposed changes to the employee share scheme.
Now, one of the other big announcements that's come through from the government this month relates to the employee share scheme rules. As many people would know, there was significant changes made to the employee share scheme rules back in 2009. Since then, there's been a lot of complaints coming forward around the way that the employee share scheme rules have impacted on commercial arrangements. Anecdotally, there's been a lot of people suggesting that the rules are actually preventing companies from issuing shares and options to employees because of the adverse tax treatment that is triggered. The government has kind of been listening to these complaints over the years and have finally agreed that maybe it is time to make some changes. So, media release was issued this month suggesting that there would be some significant reforms made to the employee share scheme rules, with the intended start date being 1 July 2015. Now, we'll wait and see whether that date ends up getting met, but that's the plan at this stage. Just in quick summary, what some of those proposed changes are, and we don't have any legislation or draft legislation at this stage, it's all very brief information. But the government does plan to have some special concessions for employees of what they call eligible startup companies. In broad terms, that's a company that's not listed, that has turnover of less than $50 million and has been incorporated for less than 10 years. The idea being that they want to encourage or facilitate those companies issuing options or shares to their employees as a substitute for increased salaries, which the company probably can't afford in that startup phase. Some of the other ideas being thrown around as part of this media release are allowing people who are issued with options, employee share options, to defer the taxing point until when those options are actually exercised, so rather than when they're granted. Now, there would need to be certain conditions and tests met to qualify for that, but we'll see what the detail looks at when the government releases more details. One of the other possibilities is that particularly for employees of those startup companies, they may actually be able to defer the tax until they sell the shares. So they can receive options, exercise the options, at some point later down the track, sell the shares and only pay tax at that point in time. That would be a significant change to what happens now. The other big change to that is not just timing, but also the fact that may allow those employees to be taxed wholly on capital account, rather than having possibly a big chunk of their discount being taxed on revenue account first. So we may see some quite significant changes over the next 6 months or so as these rules are fleshed out. The government is planning to consult with industry just to try and sort out the details, but watch this space. We'll certainly keep you updated on where things are heading, but things are looking pretty positive.
In cases this month, Rae explores why tax law is unforgiving when it comes to late payments of super guarantee.
Okay. Sometimes when a taxpayer has a position and the commissioner has another position, the taxpayer will say, that's not fair. And sometimes it isn't, and there are options to explore. But on other occasions, even though it may not be fair, it is the law, and there is very little that a taxpayer can do about it. This was clearly demonstrated in the recent case of Rae Ni Corraidh Trust. What it was the trustee was an employer, and they did not quite meet all their superannuation contributions, and that was discovered by the ATO upon audit. So they had to obviously lodge the late superannuation guarantee forms and pay all the superannuation that was due. Now, the taxpayer didn't have any problem with the fact that they owed the tax office money for the superannuation contributions that were not made on time, or the administration component. What they did have a problem with was the nominal interest rate. So the taxpayer took the view that it was not fair that they had to pay so much interest just because they were a little bit late, and they didn't really mean to be. Unfortunately, this is one of those situations where the law is very clear and it's very unambiguous. If the taxpayer does not make the contributions on time, the nominal interest component applies from the very beginning of that quarter. So if they'd only been a little bit late, within 28 days of the time it was due, they could have lodged and paid for that time, and there wouldn't have been a problem. However, because they lodged so late, the interest was calculated for the full quarter, even if the contributions were only due for a portion of that quarter. There was no discretion whatsoever for the commissioners to say, we'll waive some of it or we'll apply a lower amount. And the Commissioner is very, very firm on this. The superannuation amounts are the employee's money for the employee's future. And it's one of the few areas that the Commissioner will not be at all flexible with. So unfortunately, the lesson learned here for this particular taxpayer is do it right the first time, and you won't have to worry about fairness.
We know it's a busy time of the year, but if you haven't made a move to protect your clients against fees incurred from the cost of ATO and other regulatory audits, then you need to give Accountancy Insurance a call. Give them a call on 1300 853 897 and they'll make the process easy for you. But our next case is from Michael Carruthers, who looks at a capital gains tax case that demonstrates why understanding the trigger points for a CGT event is absolutely vital.
Now, if you take an interest in the way the CGT rules work, then the recent decision, Scanlon and the Commissioner of Taxation, will probably have a bit of interest for you. This is a case that dealt with an older version of the small business CGT concessions, and the primary issue was whether the taxpayers could satisfy the $5 million net asset value test. As many of you would know, that's now a $6 million test. What happened was we had some taxpayers who sold some shares in a company. So the taxpayers themselves, individuals, were trying to figure out whether they satisfied that $5 million threshold. Now, there were quite a few issues that were dealt with in this case, and we'll run through a few of them. First one was, at what point was a CGT event actually triggered? Now, in this case, the taxpayers had received an offer to sell their shares by way of a letter. So they received this letter from the potential purchasers with basic terms and conditions set out. They agreed to the terms in that letter. However, they didn't believe that had actually constituted a binding contract at that point in time. Another month or so down the track, they signed what they thought to be a share purchase agreement. They thought that was the thing that triggered the CGT event. So the first issue was, when is the event actually triggered? Now, the AAT said that the letter, the signing and the agreement of the terms in the letter, was actually when the CGT event was triggered. And that was pretty crucial because that then impacted on how the calculation of the net assets was to be performed for the company and also for the individuals as well. So first lesson there, and this reiterates some issues that have come through other cases over the last year or so, that we need to be really careful in pinpointing exactly when does that CGT event occur. The minute that the two parties look to have agreed on the basic terms and conditions of a transaction, there's a very high risk that they have actually triggered a CGT event at that time. Now, the other issues were around, well, let's say the CGT event actually was triggered at the later point in time. How do we calculate the assets and liabilities of the taxpayers and the company in that case? Now, what happened in this case was, after the agreement was reached to basically sell the company made the decision to pay some employment termination payments to the individuals. They were left unpaid, and so the issue was, those unpaid ETPs, were they a liability of the company that could reduce the company's net assets for the small business concessions? Now, again, the court, or the tribunal, found against the taxpayer and said these things, while they might be a liability, they weren't a liability that related to the assets of the company. In this case, the most relevant asset is probably goodwill, and the tribunal said this liability to pay an employment termination payment is not a liability that relates to the goodwill of the business. So even if there was a liability at the time of the CGT event, it couldn't actually reduce the net assets of the company for the test. The tribunal also looked at it from the other side. So the individuals who have the right to receive this employment termination payment, the question is, well, would they have had to include the right to receive that payment in their personal net asset value calculation? Now, the tribunal again gave the answer that the taxpayers probably didn't want and said, yes, you would need to include it. The taxpayers had tried to argue that this was an asset that would be used for private and domestic purposes, so should be excluded from their net assets. The tribunal said, we're not having any of that. This right is not a private and domestic asset, so you would have had to include it anyway. The final thing that tribunal mentioned, which is just worth noting, is they actually said, look, this ETP that has been declared and has been left unpaid, we would actually just include it as part of the capital proceeds for the sale of the shares. We would just lump it in with the other consideration that is being paid for the sale of the shares in the company. So it's quite an interesting case that covers a range of issues around general CGT principles as well as the small business CGT concessions. Again, remember that really important lesson. We've got to pinpoint when does the CGT event occur, because that can have a massive impact on clients' ability to pass the various thresholds and tests for the small business CGT concessions.
That's the tax roundup for this month. And don't forget, if your firm is a member of Knowledge Shop, then register for your free place at the upcoming PD. Places fill really quickly. It's the Christmas event also, so we're putting on drinks and canapes. So not only is there a great series of sessions on tax and dividends, key superannuation issues, making the most of interest deductions, and how to prepare a business for sale, but you can join me and the rest of the Knowledge Shop team for a drink to celebrate Christmas and also the incoming new year. See you then.